Energy powers every aspect of modern life, from homes to industries to global economies. Investing in energy means supporting the essential systems behind growing global demand, while striving to provide investors with a high level of income. Tune in as our team discusses why global energy consumption continues to rise, what the opportunities are for investors, and how emerging systems are powering today and tomorrow. At Tortoise Capital, we are powering portfolios with investment strategies that span the entire energy value chain system and are built for what's next. From our studios in Overland Park, Kansas, this is the Energy QuickTake in 10.
Hi, I'm Brian Kessens, Senior Portfolio Manager with Tortoise Capital, and we're here for another QuickTake podcast. This podcast, we're going to cover generally what happened in the energy value chain in the month of July. And I think the best way to do that is we get a lot of questions from different clients, a lot of inbounds, and these are the kind of the top 4 questions that we got over the month. So let's start there. The first question, the S&P 500 was relatively flat in July. With the conflict with Iran not going away, how did crude oil and the broader energy sector perform? Great question. Yeah, the broader market was flat, but energy was not the case whatsoever. If we look at crude oil, which is probably the bigger driver of the energy value chain during the month, crude oil increased from $70 per barrel to $85 per barrel, up about a little over 20%. What drove that? No surprise. If you remember, back in June, we had entered a ceasefire, and then in mid-July, essentially that ceasefire fell apart, and we saw crude oil prices spike pretty significantly from that. The broader energy sector followed that. It was up about 13.5%. Two of the companies that anchor that broader index are Exxon and Chevron. They both have large producing businesses. They also have a very large refining businesses. And both of those businesses have a lot of tailwinds. And no surprise that Exxon and Chevron kind of led the way for the broader energy value chain as we look at it. Midstream was also higher. The broader midstream index was up about 3.5%. And then MLPs specifically, we just isolate that structure, was up about 7.5%. So maybe a little bit of a catch up from earlier in the year when C Corps actually outperformed MLPs. Looking at what's happened with natural gas prices, not a lot to see here, at least in the U.S. They were down about 16%. They continued to trade below $3 per MMBTU. Bottom line is we still have an abundance of natural gas, despite the fact that demand does continue to move higher. So overall, July was a pretty good month for the energy value chain. Next question. With the Iran conflict entering its 6th month now, amazing we're this far along, and flows out of the Strait of Hormuz still at a virtual standstill, did you expect crude oil prices to be in the 80s? Short answer, no. If you would have said we're 6 months in, given what we know about flows coming out of the Strait, we would have said you're well into the $100 per barrel for crude oil prices. So why are we in the 80s? How do we reconcile this? A number of things have been going on. First, or just taking a step back broadly, there's about 20 million barrels of crude oil that have been impacted. 7 of those, 7 million barrels per day, essentially have been able to bypass the Strait. Mostly of that is Saudi Arabia using their east-west pipeline, so that's 7. Certainly we've had inventory draws. We estimate that inventory draws were about 4.5 million barrels per day. Significant, but given the fact that inventories were roughly at our average, our historical averages, not a terrible situation to be in as we entered the Iran situation. The biggest surprise to us has been China's reaction. China has reduced their crude oil imports by about 4 million barrels per day. Given that they import historically 11 to 12 million barrels per day, that's a pretty significant amount that they're not importing any longer. Our sense is they've been buying for a really large strategic petroleum reserve over the past several years. Maybe that reserve is up toward 1 billion barrels. So they're saying to themselves, why are we going to continue to import more crude when crude is $80 plus, when we had been filling the strategic reserve at prices much lower, somewhere between $50 and $60 per barrel. So China is the big unexpected change. Other than that, production is up about 2.5 million barrels per day. Some of that's higher production. Some of that is just, frankly, sanctions have been relieved on Russia and to some extent Iran, and those barrels are now hitting the market. And then demand was suppressed, roughly 2 million barrels per day. Simply Southeast Asia wanted to import crude oil, but They just physically weren't actually able to get those volumes given some of the curtailments or as a result of the Strait. So they had to do without. That's how we reconcile broadly what happened with crude oil and how we went from 20 and reconciled to the situation that we're in today. Going forward, we expect that the forward curve needs to move higher. We're still between $70, $75 forward, looking at the forward curve. That's not enough to incentivize non-OPEC producers to produce more if we're going to have any hope of refilling inventories. We think that you're actually going to have to see the forward end move higher in order to do so. I think the bigger story, frankly, has been the refined products, gasoline, and most notably diesel. China banned the exports of refined products. If we look at another war, Ukraine has been attacking Russian energy infrastructure, including refineries, and about a third of all Russian refineries are offline right now, or their utilization is about a third lower than it has historically been. Russia's also banned refined product exports. If you think about it, they're not using as much crude oil domestically, so they're actually exporting a bit more crude oil to the tune of about 1 million barrels per day. So that puts a little bit of more pressure on the crude oil price, a little helpful there, but it's more impactful certainly as it relates to refined products. And certainly refined product margins, or crack spreads as they're known in the industry, have spiked significantly. The three companies most benefiting from that in the US, in our mind, are Valero, MPC, and PSX. Valero actually recently reported. They reported EBITDA for the quarter of about $6 billion. To put that in perspective, last year, in all of 2025, they earned just about $7 billion. So they made almost all of that in one quarter. We'll see if they actually are able to eclipse the amount of cash flow that they made in 2022. Last time their refining margins were this high, given that was when the Ukraine-Russian conflict started. My bet is I'll take the over that they actually beat their 2022 levels from an overall annual cash flow perspective this year. Stay tuned. Next question, pipeline earnings, certainly we have started. Are there any initial takeaways? Yeah, I think there's a few things to note. Generally, guidance has been pretty good. Kinder Morgan and Enterprise both indicated that they're trending about 5% above their budget for what they had budgeted for this year. That's good. TC Energy indicated that they're going to come in at their upper end of their range, and DT Midstream says that they just broadly reiterated guidance. All good there. Other takeaways, Kinder Morgan in their natural gas transmission segment said volumes are up about 7% on a year-over-year basis. Gathering and processing is up about 28%. So others that are going to report as it relates to their natural gas pipeline business should be a good read-through for them. Enterprise beat, notably because of their crude oil business. Interesting, they're taking advantage of higher exports. They're benefiting from that. And they're benefiting from the fact that the U.S. is actually drawing down our strategic petroleum reserve to the tune of about 1 million barrels per day. Both of those were drivers for Enterprise. I'd also say Enterprise, we talk a lot about share buyback programs, and Enterprise continued to buy back their units to the tune of about $149 million for the quarter. So that was also good to see. DT Midstream, I mentioned them. They indicated that they had another $300 million of projects, largely tied to their natural gas transmission business, which we also think is good to see. And then the last question that we got, Williams sold 49% of their power innovation project portfolio to Blackstone for $5 billion. What gives? I thought these were high returning projects. Good question, and we definitely think that they are high returning, really good projects. But the market, took a little different view. For the month of July, Williams actually was down about 4%. Maybe one of the reasons that MLPs actually outperformed the broader C-Corp pipelines was, as it relates to C-Corp pipelines, Williams weighed on that a little bit. But let's take a step back and see what Williams is actually doing. They recognize that they have a great power innovation portfolio, and we would generally agree with them. What are they doing? They are essentially providing the natural gas, the pipeline connectivity, and the power for data centers across 5 projects in the state of Ohio. Most of them are in Ohio, but there's also one project that's going on in Utah. These are 10-year plus agreements that they're signing with high-quality counterparties. We really think that the returns to these projects are good, and Williams is very capable of delivering that. Yet the overall amount of capital to invest in these projects is about $9.6 billion. So recognizing that could potentially put some pressure on their balance sheet, and they continue to have more projects that they want to enter into or more agreements they want to enter into, They reduced some of that balance sheet exposure to this by settling down to Blackstone. Williams continues to think that these are high return projects, and one of the reasons that we know that they think they're high return is because there's an ability for them to buy these projects back starting 7 years from now. If you do the math, and Williams did the math, they roughly are seeing the cost of capital associated with this issuance at about 6.35%. To put that in perspective, Williams has a 30-year bond, BBB plus rated, and it also has a yield today of about 6.35%. So we would generally agree that this is a relatively low cost of capital as it relates to Williams' overall equity and debt stack. Taking a step back again, why is Williams want to do this? They've identified about 6 gigawatts of additional power innovation projects that they want to look to do. That would equate to about 1 BCF per day of natural gas, to give you a sense of the scale that they're still talking about. And in order to sign all those contracts, frankly, they had to open up some balance sheet capacity. Otherwise, maybe they would have had to issue equity and actually to fund these projects. They want to stay off the capital markets, so that was a key driver for why we think that they entered into this agreement. And as for the stock price, thinking about where it moves going forward, largely it's going to be tied to their ability to announce and then execute on not only that power innovation portfolio, but the announcements for another 6 gigawatts. And with that wraps it up for the month of July. Thanks for tuning in.